What is going on, everyone? Welcome back. It is good to see you all today. They have let me out of my cage. They have let me out of the dungeon,
Hmm.
and I am here to lead us all and watch Big Daddy Powell come on up. And it's good to see some of the same old shining
I
faces
could,
here. How's it going?
yeah, and I could see your little Rusty there with your green screen there.
Oh yeah, yeah, I do see that. Well, that's what happens. That's what
That's
happens
awesome.
when you don't bother. Yeah, don't bother getting the lighting fixed. But
That's
anyway, I'm glad.
that's all right, Nick.
Yeah.
It's going to be an awesome day. I mean, we had to go live for this Fed meeting because it's going to be insane.
It's definitely going to be interesting. Hopefully it'll be insane. But yeah, it's definitely going to be one to watch. I mean, everyone's going to be watching it. I mean, you see the action today and the volume we've got today. It's because, well, no one wants to step in front of what we could potentially be seeing here. But yeah, it's good to see everyone. I'm glad to see that Theo, Bordelon, Mao, all y'all, you haven't blown yourselves out yet. JT, you're all still hanging in there, I see. So I'm glad to see it. But yeah, it's good to be back. It's good to be
Yeah,
back.
yeah, and we were bringing Nick back anyhow. It's kind of like the worst kept secret, but there's a reason, Nick's here.
Yeah,
Tyler, we got to say congratulations to Tyler. He's in the hospital with his beautiful wife and his beautiful new baby,
hmm
McKenna. What's the McKenna? I forget the middle name. Oh, he's going to kill me.
yeah.
You remember what McKenna's
he,
middle name?
he can put it in
Hey,
the
yeah.
chat if he wants. But yeah. So he's building himself a little team of traders to train from birth. You know, he's got two of them now, so there should be a fleet of traders soon in a couple of years. So
Yeah, yeah, there will be a fleet. So a big baby too.
uh,
Beautiful baby. I know they're excited because he had been going to the hospital around the clock. They just had a couple issues,
yeah,
but I know they're finally glad that McKenna was born.
yeah.
9 pounds, 21 inches long. So it looks like we may have a basketball player in the
Yeah,
house.
yeah, and Tyler, he may not even remember his wife's middle name, so that's not going to be a good hint for him. But it's the same as your wife's middle name.
Yeah, what is my
So,
wife's middle name? You got to stop asking me such questions.
yeah.
Tyler, no trick questions on the stream, okay? Don't
Yeah.
ask me birth dates either. But
No, 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 definitely
yeah, so
not. But
congratulations, Ty. Welcome back, Nick. It's exciting times. And welcome all the new mentees that have come over into the group. Tyler he's on fire with his trading, and I know that he's currently doing he's doing a challenge. And if you haven't seen a video over the last couple of days on the YouTube channel describing where he is in his challenge, there's a reason for that, and it's obviously because he's been at the hospital. So and like we always talk about, professional traders, you don't want to trade when you got other things going on, and
yeah,
I think that qualifies.
yeah, just a
Other
little
things
bit,
going.
a little bit.
Yeah. Yeah. Though I would have been trading from my
Well,
bedside or
yeah,
the phone.
yeah,
I can't
yeah, yeah.
I can't hold that stuff back. But
No, no. Definitely not.
yeah,
Darcy's
and
up 6%.
actually Tyler had a great trade the day before you're supposed to leave. He didn't post a video up, and he had a really good trading day. And actually, he had two losses, right? Started the day
Mm.
off with two losses and then had one win, but that one win was a lot bigger than those two losses. So I'm like you said, I think he dropped in the chat. When he comes back, he's going to do a video on that one, get you guys caught up. So he's still ripping and roaring, and he's ripping and roaring during a really tough market.
Yeah.
So
So let me
kudos
get
to
this.
him.
Let me get this straight. He lost more than he won, but he made money because he let his winners be bigger than his losers. Isn't that just a fascinating trading concept that I just love? You know, some people don't
Fascinating trading concept, Nick. I know you
you know,
retail traders don't understand
yeah,
that voodoo or magic
that
that's
magic.
going on,
Yeah.
but it's
Mm-hmm.
it's pretty
Mm-hmm.
crazy.
Mm-hmm.
So yeah, really excited for Ty, really excited for you, Nick. Look, this is to me probably going to be one of the most important Fed meetings that we've had since the pandemic. Um, you know, it's really interesting. The Fed, I mean, look, you know, it was just 2 weeks ago, maybe 2.5 weeks ago, that we had Powell testifying in front of the Senate subcommittee and also in front of the House, and had him really royal markets by coming out kind of super hawkish. I mean, he was pretty much, guns a blazing during those hearings. And he had pretty much came out and said, you know what, we are going to stick to our guns and we may actually raise more than we thought. And immediately you saw Fed futures, you saw the swap rates go to almost 80%, I believe it was, to 50 basis points for this meeting.
Yeah.
And then a week later, or almost like 3-4 days later, we have the Silvergate crisis, which kind of kicked off the most recent banking crisis. And we saw just within days, that dropped to 0%. And it went to basically the Fed was going to cut rates at this meeting.
Yeah. Yeah.
So I don't think I've quite ever seen that dramatic of a turnaround in the Fed funds futures ever in such a short period of time. So we got a lot to talk about, got a lot to really put some context to. But what's your thoughts on that, Nick?
I mean, it's funny because it doesn't matter if we're talking about when I was here last or now, the discussion's always the same. Fed tries to come out, telegraph moves, they shock the market, then they maybe play good cop on the stream. The banking stuff's been really interesting, and that's why I know we're gonna probably spend the next 30 minutes kind of talking about that, talking about some of the other things, because the Fed is obviously the main focus. You could argue is inflation. This is going to be probably now the right up there with them in terms of what they're watching. This is definitely thrown a wrinkle, since the banking issue has started. This has definitely thrown a wrinkle in the Fed's plans, most likely. And today we get the dot plot, which is going to be very interesting, and that's gonna tell us a lot about the future expectations from the Fed. So I'm more interested in the dot plot. We know what they're going to do today. They're going to do a 25 basis point rate hike. The market has it, I think, 87% probability priced in right now. I believe was the last number I saw. But the question is, what are we doing after that? And I think right now it's sitting at I want to say it's sitting at a probability of maybe another 50 is kind of where we're sitting left, but I don't know. We'll have to see after this dot plot comes out. Yeah.
Yeah, I agree. I think any really mystery to this meeting was kind of taken away last week when the ECB kind of held to their guns with their 50 basis point rate hike. So I pretty much think that we're in line with that, but we'll see. And we'll kind of, as we get a little bit closer to 2:00 to the FOMC statement, we'll come back around to that issue. But what I want to really talk about is something, and it's kind of fitting that you're here for this, right? Because it was way back 2 years ago, geez, when we were really rolling with this show, and we talked about, what to expect when the Fed first started talking about raising hikes, right? And first started, going down this pathway.
We started by talking about raising rates. Remember that party went on for a long time.
It did, didn't it? Talking about talking.
Yeah.
But, one of the big things, I'm going to share some stuff here. One of the big things we talked about is that, look, the Fed was going to raise rates. They were going to have to combat this inflation. We've seen, inflation like we've never seen since, the 70s. We've never seen this type of inflation. Most people haven't lived through this type of inflation. And, we basically said, one of the questions we constantly get, well, how long, how much, the Fed's going to go. And we pretty much, if you remember this, I don't know if you remember this, Mo, and it's nice to see you in the chat. awesome to see Mo back.
Mm-hmm.
I missed my Mo fix there.
Yeah.
But yeah, and Bornheim and Mal will remember this. We kind of talked about, look, the Fed's going to raise rates. They typically raise rates until they break something. Okay. And guess what? Last week they broke something. And I know we've had some spirited discussions in the Discord about, how bad it was or if there really was anything broken. But, and looking at this chart, you can pretty much see that, you can see the Fed's target rate. You can see, look, I mean, the Fed typically does raise until they break something, until there's a liquidity issue and they're really forced off of the mark. Right. And you can look here. Here's another chart looking at the Fed funds breaking point. And, they never, ever seem to be able to get to where they want to go before they have to switch course and, really curtail to the equity traders and the equity markets. So, you can see here, and you can see the 70s. You can see, the long-term capital company, fall apart. You see the credit crisis, you see the taper and all that stuff. So make no doubt about it, they have broken something in the market. And let's kind of talk about that. It's an interesting case because I don't know if you remember back then when we started talking about when rates were starting to rise, one of the things we talked about was you got to be careful buying bonds, right? Because, I remember back in the 80s, there was a lot of lawsuits that came out there because you had a lot of retirees, you had a lot of financial advisors were pushing people into bonds because, they say, hey, that's where rates are going to be. That's where you're going to get income. Yeah. And then what happened was they had rates jump up and they saw all these, unrealized losses on their bond portfolios, and it made all these retirees freak out and sell when they really didn't want to sell and didn't need to sell. And you had all kind of lawsuits and stuff like that because bonds, who would think that the United States government, Nick, if you buy a T-bill or you buy a treasury bond, tell me if this is a safe statement. Is that not considered one of the safest assets you can buy? Isn't it backed by the government?
Yeah.
So how is it that you can lose money in bonds or see these unrealized losses? Well, it's a relationship to rates. Yeah. So Nick, explain to everybody, what's that relationship to rates? If rates go up, what happens to the price of those bonds?
Straight down. So you are suddenly going to look and you're like, why is my bond worth so much less? I don't understand what's happening. Because you're going to make a larger return, so the price of it's going to go down. It wouldn't make sense if you were paying more and you were making more. God, that would be great, wouldn't it? But no, inverse relationship. So.
Yeah, and that's what happened back in the 80s. They were selling these bonds as guaranteed, like safe cash. You're earning interest. It's back and guaranteed. Government's not going under. But, it's like we always talk about. It's when you start seeing your statements every month and you see like a 20% haircut on a mark-to-market of an unrealized loss on your bond portfolio, you start freaking out thinking those interest payments ain't covering that.
Yeah.
Right. And so it's the same thing going on here, and you have all these banks. The basic tenet of a bank is you give them money as the form of deposit, and they take that money or a portion of that money, and they go lend that money out to a lot of times the same people to put their money in, right? Yep. So if you put money in a bank in JP Morgan, say you put 100,000 in JP Morgan, and then at the same time you go get a mortgage from JP Morgan for 5% to buy a house. Well, guess what? Pretty much they're taking your 100,000, giving you maybe 0.5% if you're lucky, quarter of a percent, and then you're paying them back 5%, 6%, and they make the difference in that spread. So it's important to understand because, and what happens is when you have these banks, they have these capital, and the pandemic, Nick, what happened during the pandemic? What did the government do? They gave a bunch of people.
No, not only the government getting a whole bunch of people, the government gave away money. Meanwhile, the Fed gave away money. They ballooned their balance sheet up. They more than doubled it.
Flooded the market with money. A lot of people had a lot of money. They deposited. What they do with that money? They put it in their savings account at the banks, and businesses, same thing. So the banks, the banks had this money. And of course, at the time, interest rates were near zero. And by the way, banks really, the big banks, they didn't want the money. I don't know if you remember this, but a lot of banks were refusing cash deposits. They were refusing deposits. And the reason was because they knew there's going to be an issue. Because if they're going to take that money and lend it back out and buy treasuries, and treasuries paying 0.25%, okay, they're really not making any money on those deposits. So that's why at the time they didn't want your deposits, but the market was flooded with it. So, what happens is you have all these banks that were sitting with portfolio of assets that they went and bought that have such, and they bought it at a time when interest rates were very low. Well, fast forward a year and a half later, and those same bonds that they bought from the United States government, that's backed and guaranteed by the United States government, on their balance sheet, now, interest rates have gone up. They've gone up to 5-6% in some cases, in some securities. Now they're looking at their balance sheet, seeing a mark to market of their bonds of like a 20 to 30% discount from where they bought them. Now, Nick, if you buy a bond and it matures in 10 years and you're showing a 20% haircut, do you care? I mean, you can hold that thing to maturity, right?
Yeah.
I mean, if you hold it to maturity, then, there's nothing wrong with that.
You set out to make. Yeah.
You're going to make it. Okay. So it really was like nothing that anybody was so concerned about because you know what? It's, we see a haircut, but if we hold them to maturity, it's going to be fine. And they typically layer their portfolios and such. But all it takes is a crack of just one bank, and the little kindling, the crack was in a place that I'm sure the Fed was not looking at.
No.
And it was in the form of Mr. Fried, what was it, FTX?
Yeah.
Okay. FTX blew up with the Ponzi scheme of all Ponzi schemes. And at the time, who thought that would drive a major bank run? But if you put the pieces together, and this is why it's fortuitous that you're here today, your favorite bank, Nick, started the whole thing. Your favorite bank, Silvergate, right? You used to always fight. That was your baby.
I
man.
did.
You trade that all the time.
Let me see where I first, what price it was when I first started watching this thing. Because I watched Silvergate. Yeah, for those who are newer here or weren't here back in the day, when I was here religiously and leading this merry band of thieves, Silvergate was one that I had some very good calls on back before kind of the market started turning sour, and when things were still hot, because they had a lot of interesting things. They got a bunch of assets. They got I believe like Meta's stablecoin assets and things like that. This was like 2 years ago at least, and that was trading around $100 or so. Move the decimal point over 2 places, and now you know where we are. So.
Yeah, and they're technically out, right? No, you can't even give away to buy them. So anyhow, Silvergate was the bank of choice at FTX. They had, they basically, after they started, analyzing things, it got to the point where Silvergate had lost confidence. People had lost confidence, and it was, pretty much looked at that Silvergate was going under. And they decided to take themselves out. And the problem was, when this first started a week and a half ago, is that when this trouble first started, the Fed, actually, Jamie Dimon and some of the governors.
Oh, Jamie.
put a floater out to see if they could get somebody to buy the assets. And when nobody showed up, that pretty much opened the floodgate. And see, the issue is, 2008, and I traded like a fiend through 2008. This is nothing like 2008. 2008 was a portfolio credit quality issue. You had all these banks,
toxic assets.
They had toxic assets that were basically, 75% of the assets in the portfolios were bankrupt or going to be liquidated for almost nothing. So you had banks sitting with actual bad toxic products. Here, and during what we got going on here, we have really what's a confidence issue. Okay. What's happening here is more like what happened back during the 1930s, the 20s, when you had the depression, right? When you had the bank runs there. If you ever seen Christmas time, you ever watch It's a Wonderful Life? Okay. Love that movie. And you see when, what's the main character's name? Anybody remember the character's name? I know Mr. Potter, but who's
George Bailey.
George Bailey. Yeah. When George Bailey's getting ready to go on his honeymoon, he's in the cab with some cash, and they're getting ready to go on their honeymoon, and then all of a sudden they see all these people lining up at the banks and stuff, and people run by. You better get your bank now. Potter's taking over the bank, and and then he goes and finds out that his uncle has closed the doors. He's like, there's a line there. And basically everybody wanted their money back, right? And if you want to understand a bank run, just watch that scene. And they basically have to give all their money that they were going to use in their honeymoon to keep the depositor safe, right? Yeah. And because what happens is these banks, here's the thing with the banks. A certain percentage of their assets, yes, they have to keep. But, typically the LDR is really like 80 to 90%. So they keep about 10 to 20% of their deposits sitting on hand for redemptions, withdrawals. And they have a pretty good system of understanding what they need. And if they fall short a little bit here and there, they can go to the Fed, right? They could go to the discount window and they can borrow from the Fed. They could do overnight repos, stuff like that, and swaps.
Yep.
Well, what happens though is once Silvergate went under and said, we're liquidating as a bank, that started the chain reaction. And you had SIV, you had another banks, and then that happened on a Friday. All of a sudden, it was looking like, SIVB. I forget the symbol actually right now. It's escaping me, but you basically had
that SIVB.
Yes, you had a demand all of a sudden that people were like, okay, I better move my money. And the reason that bank kind of was the next in the chain, because it was a specialized bank where a lot of the venture capitalists were keeping their money. And venture capitalists and private equity guys, they know what the deal is, right? They know, oh shit, we're in trouble. And the reason they say, oh shit, we're in trouble is because the FDIC, everybody thinks their money is backed and guaranteed by the government from an insurance standpoint, FDIC.
Right.
But the problem is it's only upwards to $250,000
per account,
right? Per account. So, it's not the little guys that are making a run. It's the big guys, because they're like, oh, shoot, I got 5 million in there. I don't want to lose that money. Okay. And it's not really the issue of, are we going to have my money, because they're going to bail you out. It's how long is it going to take me to get my access? So what happened over the weekend, the Fed, Yellen, they came in, saved the whole thing, and said, look, they tried to find a buyer, they couldn't. So that basically, when they couldn't find a buyer for the assets of SIVB, then that's when we had the issues, right? And so that started the run on the regional banks. And what made it worse, Nick, is this. Okay, here's what made it worse, is that what people don't realize, and I'm going to go to the next chart, is that the Fed on March 15th, during the pandemic, basically said that the reserve requirements ratios could be 0%. Okay, everybody wants to talk and blame about Trump and I'm not getting political here. Everybody wants to blame they deregulated. No, the Fed did this. Here's an announcement on the Fed site of reserve requirements, reducing the reserve ratios to 0%. So if you give a financial company that reports earnings a chance to basically lend out more money, what are they going to do, Nick? They're going to lend out more money. Yeah. So what happened, is that, and you can see here, we pretty much have had a bank run, and we've seen into the tune of a lot of money. Banks, regional banks are just, they're just getting hit. And you can see where the Fed was reducing their balance sheet here. They're now, raising the balance sheet. It's gone up pretty dramatically. And you can see here, to put it in comparison, the regional crisis as far as how much money has been lent from the Feds, $152.8 million. Okay. Now, if you want to compare it to the financial crisis, you can see it here. It's kind of small into comparison, but it's a big deal. And it is an issue because one of the Fed's main mandates is the fact that they need to provide liquidity and make sure liquidity is in the financial banking system. So what they created was this bank term funding program, BTFP. It started out with a $25 billion backstop, but it's not QE, guys. It's not QE. So don't get all, they're basically, it's loans. They are, injecting money into the system by pretty much guaranteeing loans. And the thing is, basically, they're effectuating this through the discount window. And so you can see there, we've had $152 billion from banks access the discount window. The problem is the discount window typically is an ineffective system because the banks don't want the stigma. But with this program, it's a year before you find out who accessed the window. Okay. So are we out of the banking crisis right now? The answer is no. As you can obviously see, but it's more of, I think what really helped the matter was last week, and this is where I'm going with this, is that Janet Yellen came out and basically said, look, we are going to backstop every single deposit. That's what she said in her testimony to the Bank Senate Committee. Yeah. So they are going to backstop every single thing. And so I think that right there, that's a bailout. That's a backstop. Feds love risk backstops. Yeah. So that should solve the issue. But let's face it, the Fed's in this quandary here, right? And we even talk about Credit Suisse, and we can talk about that, when we're waiting for the Fed and stuff like that. But the Fed's in a box. Okay, the Fed's in the box. They have to, make no bones about it. They have to make sure banks and the banking system and the liquidity is solved. Okay, that is higher than inflation. They will take that mandate more than anything else, and that's what makes this so pivotal here. Okay, so Yellen's coming out and backstop that. The Fed, has done what they've done. The Swiss have done what they've done to backstop Credit Suisse, which obviously that's why you saw the bigger banks fall, because Credit Suisse is not a regional bank, obviously. That's a big bank. But the problem is what typically happens from here is a credit crunch, and that's what they're looking for. And that's what the market is that's what you need to be afraid of. But really, and let's kind of go into the charts here. Really though, if you want to look, and let's just go through it, Nick. Look, the SPY monthly chart. What does this monthly chart tell you?
Ugly. It's terrible. And then actually in a week, this monthly chart is going to be closing. So keep that in mind, everyone. We got one more weekly bar after this one, and that big monthly bar is going to close. And it looks like we got another nice little spinning top forming almost. So you got a little bit of capitulation and just kind of whipsaw going on right now. That's for sure.
Yeah. I mean, we've basically been sideways for 11 months. If you look at the weekly chart, we're kind of butting up against this trend line here, just like we rejected from the week before. You're going to expect heavy volume on, because last week you were dealing with the banking crisis. So you expect that heavy volume bar. So I wouldn't put too much weight into that. But if you kind of look in here, we are in between the 50, we're in between the 100, we're above the 200. So you can see the bottom of the banking crisis was on March 13th. We've kind of rallied out of there. But where do you see, Nick, looking at this chart, where do you see us go from here?
So there's a couple interesting things. Because if we just want to look at technicals, I mean, I'm gonna we've got an interesting level here at this 400 on the SPY. If we're talking about SPY right now, and it's an interesting level
Yeah.
for a couple of reasons. One, it's about where the 50-day SMA is. Two, it's about the high that we just peaked out at today. It's also kind of those descending highs that you have drawn there. Three, it's also almost the exact 50% retracement from the drop we've had since February 2nd there, from highs to
Mhm.
lows. So pretty much highs to lows of this year almost. That is almost the 50% retracement. So if you want this market to go higher, I think that 400, the kind of high of today, is definitely the line in the sand on that. And I'd love to say that I think the market goes lower. My issue is, and I actually don't have the full scope right now in terms of what leverage looks like in the market right now. But I saw an interesting note today from, I believe it was Goldman Sachs, and it was put on like all the usual like blog reporting websites and stuff. But CTAs are as de-risked as they've ever been. CTA positioning in the SPX is at the lowest level of all time. So that's got to be something that we got to also think about is, yeah, we're at a pretty bearish point right now in terms of market sentiment. And if you look at like the AII, bearish bullish indicator, we're pretty heavily bearish. I want to say we're about almost 50% bearish. Not quite at the 1 year bearish high, but we're close. And you got a lot of people bearish, but the moms and pops and the day traders aren't the ones who are going to move this market. It's going to be what the big boys are doing, and the big boys are going to be watching what the Fed says, and they're going to decide, is it safe to buy or is it safe to sell? And if a lot of the big boys are already deleveraged or not, it could be hard to get like an immediate move down, or at least a quick move down. But they could speed that up if they do something, if the Fed does something scary. So
Right. And the CTAs, good point on the CTAs.
mhm.
So CTAs are really, in a bind because they've gotten their ass handed to them
Mhm.
over through this
Oh yeah.
this contagion here. And and I mentioned this last week, the beginning when the crisis first started. The first thing you need to look at was, okay, where's the funds? You got some huge funds that are probably
Yeah.
got taken out because
Yeah.
interest rates have moved tremendously, and we started seeing that now this week. There's some huge funds. Lederman's fund got taken out. But the other thing from the big picture standpoint is we did bounce back above 200. We have still higher highs right here and
Mhm.
higher lows. So it's going to be interesting. If you think the market's going to keep on going, you definitely don't want to lose this low that we had during the banking crisis.
Mhm.
You can see this increased volume. Now, if you look at the 4 hour chart right here, I was looking at this level here
Mhm.
yesterday. This 396.57 is where we kind of popped up to, kind of holding in here in the higher lows. So yeah, I mean, we're kind of right in there. And here's
Mhm.
that $400 level that you talked about. And you can look across, and if we zoom this out, we really are at the top of this zipper here.
Mhm.
So we've kind of gone from zipper to zipper to zipper to zipper, and we're kind of at the top of this zipper in here.
Mhm.
And so we're definitely at that decision point. If we were to break through, look how quickly we move through this area to get up into this top area.
Yeah.
So it could be a rather quick run up to where we were even before. I know we recovered the banking crisis, but even where we were before, when everybody's kind of pulling their hair out, Mal would have a fit. But
Yeah.
yeah, you can see the hourly chart. You can see these levels all kind of lining up in there. If you look at the 30-minute chart, we're kind of hugging this trend line in here, which is nice.
Mhm.
Uh, and then let's if you go to the 15-minute, you can see we are above the 5 EMA on the daily chart, which I
Mhm.
think, again, short-term bullish. And we kind of came back down into this retracement level here from the most recent swing that we're in. Nice little bounce off of it. This is a zone that I highlighted over the last week that, we've been kind of fighting with, and it's a nice little bounce. So it's kind of like the calm before the markets going in here. Nick, tech, I don't know if you know it. Who knew tech was the safety trade?
Yeah, with with a Silicon Valley bank having a run on it, you would think that all the tech companies, that's kind of where a lot of the money might be. So, text your boy, text your boy.
Yeah, Tech's our boy, man. Tech's our
Hmm.
boy. And it's just crazy. Yeah, Christian, I'll get into NVIDIA. I mean, that thing's just on a beast. But I gave you NVIDIA. If you're in the Discord, I gave you guys that, but I'll get to that. IWM small caps, kind of nice little double bottom here. You can kind of see nice rejection at this level, the 178.05. So small caps definitely, to me, that's what I'm watching. I want to see if small caps. If you see small caps lose this 170.55 level, then
Hmm.
we're in trouble. But if they can get back above their 200, that would definitely be a positive bullish thing. We don't care about the Dow. The dollar's falling off. It had some people kind of confused by why the dollar's falling off. Well, let's go back to a simple supply and demand, right? What the Fed's doing is increasing the money supply
Hmm.
right now. And if supply is going up, what's going to happen to the price, Nick?
Hmm. Hmm.
It's going to go down. So I expect, look, we were in a nice active sequence to the upside, dollars falling off. I expect it to continue to fall off with what we're seeing because, again, I think, we're still not completely out of the woods with what we're seeing in the banking industry. Well, look at this drop real quick in the treasuries. Pretty crazy drop
Hmm.
there. And it kind of shows you that, and we talked about this. Look, when interest rates go up, right, which they're popping up, usually that's not a good thing for stocks. But we said, we just spent a year and a half, trailing rates. If they went down, the market goes up.
Yeah.
Well, we said last week it's going to be a flip flop. It's reversed because now what you want to see is you want to see rates going up. That means they're stabilizing, at least temporarily, and that's what we've gotten.
Yeah.
Market had a nice little bounce, and it's all because rates have stabilized and kind of come up. So, you got to understand those relationships. And when they flip on their head, especially when you have issues like we just had with the banking sector. The VIX is the thing. I'm curious to get your take on the VIX because this thing just dog shit to me.
Yeah.
I mean, first off, the VIX was the first thing to tell us, okay,
Hmm.
that this market issue with the banks, not
Hmm.
a big deal.
Hmm.
Okay. Because you're telling me you can't even get the VIX up to here where
Yeah.
we were several times, back in October. All we could muster was a little, up to 30.
Hmm.
Just crazy. So the VIX screaming to me, look, bank's not a big deal.
Yeah, and what's interesting is I was going to bring this up as well is if you look at the SPY or any of the markets, we did a ton of volume at that at that trough after we had kind of dropped, and most of the volume was done on the green days, which tells me that you probably had a lot of institutions who probably were like, this isn't gonna like this, we're not gonna die from this. This is they probably knew what the playbook was gonna be, and they accumulated a bunch, and now I could see them selling into whatever pop we might get. So because the
Yes, that's a
volume's
great
really
point.
dried up since then, so them accumulating into it, the VIX probably just reinforces that story, that we didn't see any selling, and we didn't see the serious amount of panic selling and put buying. We saw probably the opposite, which was the smart big boys who knew the playbook buying up
Right.
into that panic. So
Which, of course, is Mal, you're exactly right. This is exactly why you had the safety trade in the rotation into tech,
yeah.
right? Because anytime, tech, if rates are going down, that
Hmm.
means the future values of those earnings are
Hmm.
now more favorable. And when rates are going up, it really puts a crimp on, because tech companies typically, they're not producing earnings except for maybe a few years in the future. And so higher rates makes those earnings devalued.
Hmm.
So yeah, you definitely had that rotation based upon the rates going up. And the banks are starting to stabilize in here, but they're not like racing off the bottom, which is what's telling me right now, we're using the banks as our leaders today.
Yeah.
You look at the KRE, and by the way, the regional banks gave you the clue. We posted this. They have something in Discord called Mike's Corner, and I post every morning these charts.
Oh
And
God.
I posted this chart right in here and said, "Hey, there's something going on with the regional banks." And this is what you saw. You saw this drop off. So I'm looking at the regional banks, and if you go to a more of a outer
Hmm.
view here, you can kind of see where we are And I'd like to see them they are stabilizing,
Yeah.
but they're not like racing off the bottom as you would expect if everything's just hunky dory.
Which is also interesting because Yellen yesterday had specifically pointed out small banks and said that they're gonna back small banks, like they're gonna bail out the small banks as they need. But
Yeah,
that'll be
it's kind of
interesting.
surprising. And what's also surprising is, like FRC, that's the one bank everybody's watching.
Mm-hmm.
It's the bougie bank in San Francisco. And you had 11 banks come in and deposit 30 billion with them. This was last week. And, FRC got a little bit of a pop, but then just dropped completely from there.
Yeah.
So if 30 billion's not enough, what is enough?
Yeah.
Okay. Now, at its 1 day peak, SIVB had a 42 billion request, which is what forced them over the weekend. So, I guess 30 billion, maybe needing another 30 billion, who knows? But the interesting thing, and this is what Christian brought up, is semiconductors, Nick. SMH, look at this thing. This thing, if the market's really worried about the world falling apart, you're not going to see semiconductors running almost at highs.
Yeah.
Look, we gave you guys this concept a month ago. Okay. The reason NVIDIA is running and the reason semiconductors are running is one thing: AI. Okay. Artificial intelligence with ChatGPT has changed the game. And this is, you see AI. Well, NVIDIA is the company positioned for that. And that's why you've seen this massive run out of, the PE, I'm sure Mal can drop in what the PE is of NVIDIA at this point, but I believe it's higher than it was when they were at all-time highs. So if you look at the monthly chart of NVIDIA, when they were here, I think I read somewhere that their PE is higher here because obviously the earnings are completely different from where the earnings were there. But NVIDIA, I wouldn't bet on NVIDIA slowing down anytime soon. It's not a buy for me right in here. It's a good day trader.
Really, great day trader.
It became a great day trader. It was a great trade for us today. They just had their investor day yesterday. We actually had a good short on it on to sell the news. But the fact that they're back and still running, just be careful. I mean, they're running, this whole sector is running on AI, but NVIDIA specifically, because they are positioned, going forward. Yeah. So just crazy.
Yeah, we've only got about 12 minutes here, so I wanted to talk about, I guess, what the expectations are, just so people know and have that in their mind as we go, as we get into it, so people aren't wondering if there were any nasty surprises. So I think right now the 80% price in probability 25-point basis hike with a dovish leaning message most likely. Probably play good cop here. Now we'll have to see, again, like I said, the dot plot I think is going to be the most interesting. I think the expectation is 50 basis points more in hiking. But I think also, I don't think we get much of a move off of the initial numbers release at 2. I think everyone's going to wait to see what Powell has to say.
I think you're right, Nick. Yeah. I think this is a FOMC that you want to kind of hold off from the buy and sell buttons.
Yeah.
Right now, because I think you're getting initial reactions. And the one bond, we're usually watching the 2-year, the 10-year. You want to watch the 2-year. Okay. So we've talked about this yield curve dramatically steepened most since 1980. Well, during the banking crisis, yield curve has dramatically steepened based off the historic run. We've never seen the 2-year run as quick as it has. And so you need to watch the 2-year. Yeah. Okay. The 2-year is the one. It's the crisis management tool, and it's what the institutions are looking at. It's what you need to look at. And I agree, Nick. So, on the table, I think we pretty much agree 25 basis points. If they go 50, like was projected prior to the banking crisis, I could see panic there possibly.
Sure.
If they go 0, which is which by the way, Goldman has come out on a limb and said they are going to go 0 today. Okay. If they come out and do 0, I think we get a pop from the algos,
Yeah.
but I think that is something to be sold.
I
think
think
we
the big boys
sell
that we talked about
hard.
accumulating during that drop are going to sell straight into that. Absolutely.
Zero
Absolutely.
tells me, zero tells me, what does the Fed know that we don't know?
Mm-hmm.
That's
Mm-hmm.
what zero tells me.
Mm-hmm.
Okay. So, yeah, I think they are going to thread the needle and they're going to be right in at 25 basis
Yeah.
points. I think there's a greater chance of 0 versus 50.
Yeah.
Don't put it past the Fed pivoting, but I think the fact that we've kind of calmed down a little bit from the banking crisis,
Mm-hmm.
the markets have reacted positively.
Mm-hmm.
And what we didn't talk about during the what really caused the problem was when the Swiss bailout. You know that, Nick,
Yeah.
they changed the country's laws in order. Typically, equity
Yeah.
is the last to get paid.
Yeah.
Bondholders
Yeah.
get paid out first. Well, they basically equity got $3 billion of it. Bondholders, AT1 bondholders got wiped out. And the reason that was important was because it threw the bond markets into turmoil, because then everybody's like, look, why am I going to go buy bonds if you can just change the rules?
Yeah.
Okay. And the risk parameters. Well, immediately the day after, the ECB, the Bank of England, and the Fed came out, and they all said, look, I guarantee we will not do that.
Mm-hmm.
This was a special situation because, if a $2 trillion Credit Suisse was allowed to fail, we wouldn't be sitting here talking about the shit we're talking
now
about.
Now I do want to say that I'm of the nature that obviously they can't fail, but Credit Suisse,
not.
Credit Suisse, right? Well, yeah, but on a side note, Credit Suisse, because I think they're run by a bunch of morons. So
They
just
are.
to talk about some of the things they've been caught in lately. Remember Luck and Coffee? Remember good old Luck and Coffee? Yeah, they were the underwriters for that one. Remember our good friend Archegos Capital? Yeah, they had a big old chunk of change, couple like 6 billion with them. They've gotten hit by, I think, more fines than most European banks put together, because there was a big finding like a decade ago about them helping U.S. Customers evade taxes. So they are just doing whoever is making decisions like this, they're embroiled in almost every, if there's a large financial institution that's going under, or a big scam like Luck and Coffee or Archegos or any of those, they always seem to be involved. I mean, all the banks are involved to an extent, but they always seem to be the biggest involved.
Yeah, and they had the rogue traders.
Yeah,
And
yeah,
they're just poorly run. They were a poorly run company.
yeah,
But, getting back to the Fed,
yeah,
I think, QT, it's going to be interesting. Are we going to hear about QT? Is that off the table?
yeah,
I think the reason this is the most important one in a while, it's because they're basically going to take that statement and they've ripped it up. Usually we're highlighting lines and words, they change. I think that statement gets ripped up.
mm-hmm.
I think the market, what you're going to look for
Mm-hmm.
is in, like you said, the press conference.
Yeah.
Is if he needs to come out and be as emphatic about the banking situation as anything. He needs to show confidence. He needs to say, banks, we will not let them fail. Your deposits are secure, just like Yellen did. And I think he will. And then I think we rip up on that. I think if you hear that, I think we rip up. Like you said, the question is in the dot plot, are we going to see the 50 basis points more, which we were supposed to, or is he going to be dovish and say, 25 basis points?
Right. Right. Well, I'm wondering if we're going to see a disconnect between the dot plot versus what he says, because the dot plot, remember, it's going to be all the other Fed governors too, and you're going to get to see what everyone else in the Fed is thinking, and then you'll hear the Fed Powell come out and pad whatever that says. So that's going to be interesting. And I think that we'll probably see some revisions in terms of Fed's forward guidance, because the Fed, in terms of economic forward guidance, let's be honest, the Fed needs to get rid of forward guidance, but because it's always terrible. But people are expecting them to revise the growth forecast for the year from 0.5% to 0.4%. Probably won't see a change in jobless expectations. And they expect the core's PCE to be revised higher as well. So.
That's a good point. And, we get the SOP, we get the dot plot. So that's another reason this, is such an interesting one that we're kind of running with.
Yeah.
I think, look, this typically we're using our Fibonacci's, letting the market kind of do its thing. But right now, I'm more inclined to just kind of sit back. Let's see, because I think you're going to get more fake outs
Yeah.
than we typically do. And we usually get the three moves, and we always talk about that. But I think we're going to see a lot more fake outs. But I think this is important, fundamental news event going forward. If you're trading off the dollar, if you're trading gold, if you're trading based off interest rates, based off commodities, we've seen a rise in commodities recently, and I'm almost ready to say, look, commodities, let's go, baby.
Yeah.
Because if they're going to really pull back the reins, I think commodities can run. But it's going to be interesting to see the reaction in banks, Nick.
Yeah. Yeah. It is. It is. And it's going to be. I want to see what the turnaround time was in terms of the Fed last time. Because another thing that we didn't talk about, I mean, we talked about it a little bit, and it was inherent with all of this actually. But the Fed, when in 2017, when they first, last time they decided to try to reduce the balance sheet and raise rates before they kind of broke things. It wasn't to a bad extent, but they broke things. They managed to lop off like about 700, I think like 700 million or off of their balance sheet. We haven't even. First of all, the balance sheet is 3 times the size it was then, and we didn't even hit that same number. I mean, the Fed.
Right.
We talked about how we talked about for years. For anyone who wasn't here, we were always saying how late the Fed was in raising rates. They were a year too late in doing all that. And now this is probably some of the repercussions. But we'll see if they do the same kind of thing, because when they reverted that buying in 2018, they didn't wait very long before they started cutting rates. I want to see.
No, you had the temper tantrum, you had all that
Yeah.
stuff. So yeah, you didn't really have any of that. So what's interesting is you kind of got the dollar. It's kind of calm right now.
Yeah.
I'm kind of setting up some charts. Maybe I can share it. We can follow it. I'm going to be watching the VIX. Let's put this on here so we can see what the VIX is doing. I mean, the VIX is just completely dropped off. And let's kind of, as we get close here, can you see that, Nick?
Yep.
All right. Actually, I'm going to stop sharing for a minute and move it over to the other screen, so that if I, have any issues, I can switch it off. But minute and a half, baby. Minute and a half.
You are sharing the wrong screen.
Oh, I am?
Mm-hmm.
Sorry about that. Isn't that nice? That's why I did it with a minute and a half.
Yeah.
So the market's kind of calm here.
Mm-hmm.
Flat VWAP. If you see here, this is the 2-year rate, which this is the 2-year note. So inverse relationship. If this price is going up, that means rates are coming down. It's just the way Thinkorswim has this. It's really stupid. What are you going to do? So I'm just getting everything set up, because I'm going to watch the banks. I'm going to see how the banks are reacting to this. I think it's an important reaction coming in, and I'm getting ready to go.
We got 15 seconds, so we'll see. And like Mike warned others, this may be one where you got to be very careful with your buy and sell orders. We'll have to see. Obviously, if there's a surprise, that's something else entirely. But
all right, here we go.
Yep. All right, let's see. Nice drop in the dollar. Let's see.
Market's really not doing anything, are they, huh? All right, 25 basis points. 25 basis points. So 25 is the number.
So no surprise there. As per usual, these things are telegraphed. It's pretty much exactly, I think, what people were expecting. Here I've got the press release here, so I can skim through it. U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. Yada yada yada. The committee will closely monitor incoming information and assess the implications. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return to 2% inflation over time. So more hikes is what that sounds like. In determining the extent of future increases in the target range, the committee will take into account the cumulative tightening, the lags with which monetary policy affects economic activity and inflation, and yada, 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 and financial developments. The committee will continue reducing its hold of Treasury securities and agency debt and mortgage-backed securities, and as have been in the previous plans. So no change, and it looks like there's going to be further hikes. Is kind of those. That was just a press release.
There will be one more 25 basis points. So they're at the dovish. They're more on the dovish side of things. Okay.
Oh, here's the dot plot.
And 75 basis point cuts in 2024. So Nick, if you want to share the dot plot,
sure.
Go ahead, I'm sure.
Let me pull this up here.
There, and there you go.
Here. Pulling up the proper screen here. Now I pulled this off Twitter, so I'm hoping that I'm pulling from a reputable source. This is the first thing I saw, and I'll share it so you could see it as well. There's the dot plot there. So this is 2023, where we're sitting.
Okay.
What did we just hike to? So here's where we're anticipated to end for 2023. Looks like the majority sitting at this. What is I can't even see in here. Can I zoom in a little bit? Let me go. Oh, never mind. It's not going to zoom in the picture. But anyway, yeah. So here's that 2024 that you were talking about, where it looks like we're getting that 75 basis point rate cut, and 2025 looks like maybe like an additional 75 or so.
Right.
So yeah, there's your dot plot for anyone that wants to see it. So.
Okay, so we got the 25 basis points, which I think is positive.
Mm-hmm. Yeah.
Okay.
Yeah, it's not 6% Mo, but then you got one person up here near the 6. I don't know what I want what they're smoking up here at the top of this little dot plot. I love this dot here too on 2025. This is the one Fed governor who says just let it burn. For anyone who hasn't seen that, but anyway, I'll let you take back over because you may want to pull up the charts here, let people see what the dollar and the market are doing. Yeah, we're getting some fun action here.
Yeah, we are getting some action. Tyler said buy gold. Gold's up pretty good on this move. Dollar's down. The VIX kind of just hanging there. Yeah. I mean, I took off the 10 rates were pretty much down. If you look at the I'll put rates down here at the 10-year, you can kind of see. So
that one guy's J Powell.
Yeah. I sorry, Theo. Yeah, I mean, I'm trying not to be as aggressive. I did catch a little ride up in here. I'm bullish on this right now. But I don't know. I would be chasing it. I think I'm going to wait to get aggressive on the Fed pressure. I'll draw some Fibonacci lines in here. Look, 40-50 was kind of where the liquidity was sitting on. If you look at the heat map, 40-50 is where the liquidity was pretty much sitting. We're getting kind of a little bit of a run now out of here. So I kind of wanted to kind of slow down a little bit. I told you guys ahead of time I wasn't going to be as aggressive on this one.
Yeah.
I just but
yeah.
So first inkling, I'm bullish on this.
Yeah, and what's interesting is I'm looking at the latest dot plot versus the the one prior. Not much change. In fact, it actually looks like it's a little more hawkish.
Got you.
I'm maybe slightly more dovish. I'm trying to like kind of just quickly sum up the dot movements. Looking at the dots here. Um, it's not it's really not very different. It's really not very different. I'm actually not seeing too much of a change.
Yeah,
I'm
you got
really not
stocks
seeing
ripping right
much.
here, tech's ripping. I mean, rates are going down, so they're gonna rip here.
Man, look at that
Why?
market go. Mm.
Yeah, she's going.
Look, I would just warn people, because we obviously have 24 minutes until the press conference, and if a lot of people did load up at the bottom, we'll have to see what they do as a result here. But nice movements. Hmm.
Yeah, looking here. Um, yeah, the yield curve is going to collapse. So I think the important, remember what I said, U.S. banks sound resilient. U.S. banks resilient, but events to weigh on growth. Fed will
Yeah.
continue same pace. Firming may be appropriate. Um, Median forecast seems rates at 5.1%. End of 23, 43, 4.3%. So there's where you're getting, um, so you're not seeing, this is pretty much right down the line. He pretty much
Yeah.
threaded the needle down the line, which is what we probably pretty much expected from this Fed governor.
Yeah.
Um, I'd be careful. We can let me kind of go down to a more cleaner chart here. So if I'm drawing a Fibonacci like we typically do from these events, I'm kind of looking in here, I guess. Uh, we got which makes sense. You kind of got the 50% hanging in here, Nick. So let's see what happens if we can get a 40-50. If you looked at the heat map, that's pretty much where the liquidity was sitting.
Hmm.
And yeah, I mean, Nvidia on fire. Yeah, of course. I mean, Nvidia is a tech stock, and just based off this, you're going to let it run. It's going to run based off of rates falling off. You got the 2-year just pushing it pretty hard as far as the note itself and rates falling off. So you had the 10-year fall down to 3.5%. Now it's kind of bounced off that. So we're getting a drop into this 50% level. Maybe see how I'd like to see maybe some sideways action in here, hold a higher low, and then maybe buy for a bounce out of there, possibly. Anything that you're seeing, Nick?
No, I'm trying to see if there's anything else that anyone's put out that might look interesting, but
Got gold kind of falling off from a huge bar up on the news. You got rates kind of pulling back up a little now. Watching that here. I'll let you know if I'm taking a trade in here. You have, we're at that 40-50 line. I'd like to see maybe a little piercing of that, maybe a look below, and then maybe pop up would be nice. But everybody knows the pressure's coming, and so I think that's a tough thing because the pressure is going to be the deal in here. So just kind of watching this now. Let's see. Let me take a little buy off here to see if we get a little run. See if we get anything going out off this 40-50 level. I took a bounce off the 40-48, just trying to get maybe 5 points here. Not low risk. Come on, one more point, please. Doesn't look like we're going to get it.
yeah. So I'm looking at some of the and here, let me post this in the chat for anyone else that wants to sift through it. It's just a whole bunch of charts that the FOMC put out in terms of like what participants put for all their projections in terms of PCE, GDP, core PCE inflation projections for 2023 look like they hiked up pretty high on the, at least in like what all the Fed participants
Mm-hmm.
projected. I mean, in December, you had the low end of participants. You had one or two participants in the 2.9 to 3 range, and you had a decent amount from 3.1 up to like, whatever. Now, I mean, the lowest is a large portion of the participants at 3.5 to 3.6. So definitely there's the core PCE expectations hotter like I think everyone expected them to be. Not that the Fed has ever been good at projecting inflation, let's be honest. Um, what is this? Change in real GDP. No change in expectations, it looks like, in terms of unemployment rate
Right.
from what I'm seeing. Hmm.
Here we go. Come on. I'll take that. So I bought in here. I added in here. If it broke this candle, I would have gotten out, and then I kind of sold up into this pop. So small gain. Just again, I just I'm not liking. I mean, I'm seeing Tesla fall off here. So be careful. I see Tesla falling off. See Nvidia kind of pulling back from their run. And I think just being cautious in here.
Mm-hmm.
If you don't have an edge, you don't want to just put yourself out there. If you are going to trade during any of this, make sure you just reduce your risk.
Yeah.
I think we're going to have a lot better opportunities once the
Press conference starts.
press conference hits.
Yeah.
Yeah,
We got 17
and
minutes on that, so.
and look at some of your leaders, guys. Like Tesla told me to get out of this position up here. Okay. And you might say, well, what the hell's Tesla? Well, it's a lot of times you can see the institutions, Tesla on a nice little run. It's a leader. If you start seeing them bailing out of that earlier, then it's a good sign that maybe the indices aren't going to hold up. So, this was not an easy trade in here, and it's just right now not given a good setup. So let's let the markets don't get your FOMO, don't get FOMO. Let's see what happens overall. Nick, what's your gauge? Because I like to know, is this a bullish? Was the Fed bullish? Was it dovish going into the presser? Because I think he's smart enough to knock this presser out of the park. So what are you seeing out of this? That's what I want to kind of look at as we go forward on some of this, because we got to 25 basis points. I think that was threading the needle. So I think we're fine on that. Hold on one sec. Just pulling up some other charts in here. So I'm seeing KRE after popping above VWAP, kind of pulling back, not at lows though. Okay, not at lows. So it hasn't gotten down to lows. You kind of got some lows to kind of play with around here. You got this 4032. So right now ES bouncing off of VWAP here. You have gold. I know Tyler thought this might be a bullish thing on gold, and it definitely pushed gold out of there. But if you draw Fibonacci on the gold here, you're below the 50% retracement level. You got the dollar bear flag in it. Looks like dollar wants to fall off. You have rates pretty much on a slow drip down here after kind of recovering. So we want to watch that trajectory as we're kind of looking at that. 2 years still seems to be falling off a little bit. And Let's see here. So, so don't get over your skis. Getting some nice fades here on some stocks. Some really nice fades. Chris M, wonder if you're in the fade. That's our fade trader. See if you're catching any of these fades here. So we now have a 62% chance in May that we're going to have a quarter basis point hike, which is nice. I see they dropped the phrase ongoing increases. So, yeah, it's hard to see really any other change in here. Trader 62% chance. Waiting 13 minutes to get to where we really want to get to the presser. That's where I think we're going to get some stuff. So Borno, you did not grab the VIX dip. I tell you what, VIX definitely, I tell you what, the VIX dip did not even match the low of what we saw prior to the Fed. Okay, so that kind of tells me something that we're seeing a reaction in the dollar, which we expect. We're seeing a reaction in rates, which we expect. But interesting that the VIX dip, they couldn't even push it below 20 here. So I think that's interesting. Born alarm, good luck with your boil. Yeah, I see QQQ's kind of bouncing off VWAP, IWM kind of hanging at VWAP. We're kind of just hanging in here, but I wouldn't get over top my skis in here. Yeah, I you know what, Theo, I'm kind of thinking too, man. I don't know why I'm thinking so bullish and leaning so bullish going into this press conference, but I'm kind of thinking the same thing, that I feel like we're going to get the mother of all green candles out of here at some point. And, watching IWM, typically a slower mover behind it. But, we're starting to get a little pop in some things. We're, running up into that 40-50 area. The 40-50 area, guys, that's my area of really, that's where a lot of supply was prior to the Fed. So I think that's a big part. What do you think, Nick?
I mean, it's the price action's definitely feeling bullish. I'm leery, but especially now that we're pushing back above that 400, it feels like you could get a little bit of a squeeze from all the doomsayers, the doom and gloomers. I think that if we do get a squeeze, and say that there were a lot of people who were feeling doom and gloom and loaded up shorts on this, if they did, because VIX is still elevated, it wasn't as elevated like you said, and if they did get squeezed, then I don't think it would last long, because I think you would see whoever accumulated during the dip dump into that. But for the short term, it's interesting.
Mo, the housing market. Look, I mean, you can see how sensitive the housing market is to rates. Okay, rates start continuing its ascent. Then you're gonna have issues again in the housing market. So you saw mortgages all last week kind of blow up. People kind of taking advantage of that. But the other issue is, don't forget, typically what follows a liquidity crisis is a credit crunch. So, that's something that institutions are watching. So here you can see, guys, if anything, we're seeing that supply of 40-50 not being able to be broken. right, Nick? I
Yeah.
mean, that 40-50 right in here
Hmm.
is, it happens to be the 50% retracement. They're having some trouble getting through that supply. So you're definitely watching that. You can see these wicks up here.
Yeah. Yeah. We got what, 9 minutes, so we're getting there.
Me and Theo, what are you thinking, Nick? Me and Theo are kind of thinking we're going to eventually get the mother of all green candles out of here at some point.
I think the longer we sit up here, it's definitely possible. For
Good point,
sure.
by the way. Right.
Yeah.
Good point. We're not falling apart.
Yeah.
So the initial reaction is, and again, you can't trust. I mean, if you're trying to make trading decisions
Yep.
based off what's happening here, you can't really trust it.
Hmm.
But we are holding.
Hmm.
We haven't even tested back down to the 40-32, the scene of the crime yet.
Yeah. Yeah. So the longer we're sitting up here, the more likely we'll see some maybe running and gunning. Um, I could definitely see that continuing for a bit. But
Yeah, I mean, FRC, which is one of my leaders, Credit Suisse, kind of watching them, JP Morgan. It's interesting that, JP Morgan kind of sitting above VWAP and holding in there. KRE is kind of head back down to lows, it looks like. Not falling apart. But it's definitely. I mean, look, and I agree. I'm kind of reading through some of the tweets and stuff. I definitely agree with the fact that, look, the Fed had to raise rates here to maintain their credibility.
absolutely.
So here's the statement: the U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity. Hiring and inflation extent of these effects is uncertain. The committee remains
Yeah, that was the press release from earlier. Yeah. Yeah, and that'll probably be pretty much the script that Powell sticks to. That like they don't think anything in the long term is gonna break from the bank stuff. Doesn't seem like they're changing any of their long term projections because of that. So the question is just gonna be how the market interprets that.
Yeah,
I think the market already agrees, considering the amount of accumulation we saw on the initial drop.
But, yeah, I mean,
let's hope resilient is not the next transitory. That's true. Inflation's transitory. It's still transitory. It's transitory, and it's way out. It's good old transitory.
Well,
so someone should look and see when the last time Powell said the word transitory. Probably hasn't been a while. It's probably been a while.
Say it all the time.
Mm-hmm. Oh yeah. Inflation's transitory, baby.
I think we were talking about doing the drinking game every time you did transitory. So now
might be resilient now. Banking sector's resilient.
Yeah, everything's transitory along. Everything's transitory when you got the government willing to back risk.
Mm-hmm.
I mean, the reason I'm so bullish. Look, the banking crisis is not over. Okay. It could be over. I mean, again, looking at credit spreads, looking at interest rates, recover a little bit. It looks like this is the banking crisis going to be a nothing burger, or not a nothing burger, but it's going to be something that, it's not going to take down the market.
Mm-hmm.
And it looks like it's not pivoting the Fed at this point. Though I will argue they did pivot from 50 basis points to 25, but that's splitting hairs.
Mm-hmm.
But don't get complacent. Okay. You still got to watch banks. You still got to watch interest rates. I mean, KRE right now is making new lows. Okay.
Yeah.
So I'm watching that. I'm watching the reaction to banks. And I think they were probably good short. They were probably good shorts on a little pop up. That's probably, if you're going to risk during this play, and I apologize for not thinking about this ahead of time, but if you're throwing some, lotto money out, I think the pop into the regional banks would have been the short play. Obviously, the charts say that, and that's like, it's easy for me to say that. But thinking through the fundamentals, 25 basis point hike is, not saying we care about the banks that much. So
yeah,
saying inflation is more important. But I still think Yellen saying we are going to backstop every single freaking deposit in the system. I mean, it takes off risk. Why are you worried about risk at that point?
Mm-hmm.
This is how crazy the government is.
Yeah.
So we're getting closer. I think as we get closer, it might get a little bit more. I mean, look at gold 5-minute over there, kind of flagging nicely above the 50% retracement level. I don't like from the stock standpoint is the fact that the regionals are at lows. I would have liked to seen them bounce a little bit. So Nick, you all set up for the Fed?
Yep.
Got your charts. I'll stop sharing. I'll let you get ready for that in case there's any technical difficulties.
Yeah, let's see if we can get ourselves set up here. Hang on one sec, everyone. You're gonna see a blank screen just for a moment while I make sure that we set ourselves up here properly. And okay, we're good. Yeah. And I'll turn the audio on once the elevator music's done and we get our boy Powell out here.
All right, so
dollar about to make a new low. See, market's lagging a little bit. Mm-hmm.
Yeah, it is. Born on posting Discord option flow for SPY. Thanks for doing that. Not looking bullish. Seeing a lot of flows in some puts. Again, that could be from a protection standpoint, but I would agree with you.
Interesting. So for looking at the CME group, the Fed Watch tool, looking at like Fed futures and what the market's pricing in, probability of zero rate hike in May went up 10%. So it's pretty interesting. It still favors a 25 basis point rate hike, but
right.
That's a pretty decent jump. It's a pretty decent jump.
Kind of got Tesla back above VWAP, back where it kind of fell from last time. You got a little bounce off the low. KRE, watching that a little bit. Like you said, dollars coming back down towards lows. Rates are kind of falling off. I took just a little starter just in case we get a little bounce going into the press conference. Sometimes traders can't hold themselves back.
Mm-hmm. Yeah, we're seeing TNX and
fishing
dollar roll
line
back
target
over a little bit.
Yeah. AMD in the video is like F your concerns.
Yeah.
Kind of got IWM. You got IWM back above VWAP. $15 seconds. Are we going to get this algo push here? We're in the chopping around this 40-50 area. I'm going to take a little of those profits before I. In case the algos decide to push us the wrong way. All right, there they are.
Wrong one. Sorry, there we go. Oh, let me also. I'm gonna reshare with you so you can hear the audio. Make sure I'm piping the audio for you.
Awesome.
Hey, Pal's doing a railing a line of coke real quick, getting himself hyped up, trying to make sure he's ready to rock this.
Think?
Yeah.
Oh man, it's just taking me hard, Nick, from wanting to buy this.
Yeah. Can you hear it?
Here we go.
Good afternoon.
Let me know
Before
if the
discussing
volume's
today's meeting,
good,
let me briefly address recent developments in the
with
banking
everyone
sector.
watching.
In the past 2 weeks, serious difficulties at a small
Blue
number of
tie,
banks
sell,
have
sell,
emerged.
sell.
History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe.
I took that
With the
little
support
pop
of the
there,
Treasury,
Nick.
the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000
If we pop
jobs
here,
per
this
month
is now
over
the
last 3
fourth
months.
with three consecutive higher highs
at 3.6%.
since this first move on the SPY.
The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories.
Lows or your stops.
Core PCE,
Yeah.
excluding those, core PCE prices rose 4.7%.
There you go.
In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%.
Well, we went back to the scene of the crime now.
Yeah.
Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored.
That was the
as
largest
reflected in a
1
broad
minute
range
candle
of
we've
surveys
almost
of
had so
households,
far.
businesses, and
this SPY.
forecasters, as well as
Yeah.
measures from financial markets.
There's a bunch of stops getting
The
hit.
Fed's monetary policy actions are guided by
There you
our
go.
mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, let's go.
All right, let's go.
Thank you, Colby Smith with the Financial Times.
Hey, Colby.
How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight
Of
among
course, this was
mid-sized
gonna be the
lenders
first
in
question.
particular, has
course.
ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized.
There we
over
go.
the
You
last
gotta
week.
buy when he says he's good.
And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Uh-oh, regulation, sound.
Follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we considered, we did consider that in the days running up to the meeting, and you see the decision that we made, which
Yeah, we considered a
I'll say couple
pause.
things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected. And really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes maybe, some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases
It's our boy.
and firming?
It's our boy, Steve.
Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing.
So it's a softening of the language.
Clearly, what we were doing there is taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case.
All right, good stuff. I'll be getting some targets
the path
to the
will
upside filled in
might
here.
look different. It's also possible that this potential tightening will contribute significant.
Look at
tightening
gold
in
breaking out.
credit
So good
conditions
call
over
by
time.
Tyler.
And in principle, if that means that monetary policy may have less work to do. We simply don't know. So
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your
Crazy
testimony
eyes?
2 weeks
Oh, yeah, it's
ago,
crazy
you had
eyes.
indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your
5-minute
colleagues or
minute.
those of the
Beautiful,
board
Nick.
staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent.
A little bounce
and
on
it's people,
rates here.
It's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part kind of the possibility of credit conditions tightening really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
You know, we know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, you know, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Nope,
Hi,
that
Victoria.
excited the market, not doing anything
I
other
wanted
than
to ask,
high rates.
You, along with the FDIC,
Not
and the
dumping
Treasury,
supply into the
Fed Board
markets.
decided to invoke the systemic risk exception
Pretty much
to
trading
allow
around a
uninsured
KRE,
depositors to be protected
VIX
at
is
these two
lower,
banks.
so
I
I'm
was just wondering
popped
if you could speak
long
to
in here.
why that decision was made. Was it purely a confidence issue, or was there a concern
I mean,
that
VIX
there would be
keep on
some sort
falling
of
off, which is
economic
good,
contagion or
especially
financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, you know, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And
This is pretty
so
dovish to me so
what
far.
we did was early Monday morning we sat down and said, let's do this,
Yeah.
and he was obviously going to lead it in his capacity. So I don't, you know, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. Yeah, absolutely the same. The story is intact. So it's really three parts,
let's
right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, you know, that's just something that will have to come through.
I mean, Theo, it
through
depends on what type
softening
of
demand
trade you're looking for.
and
You know,
perhaps
if
some
you're just
softening in labor
scalping the
market
moves,
conditions.
then
we don't see that
I'd
yet,
be watching
and
this
that's
action
the
right
first
here on the 1
56%
minute.
of
If
the
you
index.
want to try to
So the
hold for a
story is
longer
pretty
term,
much
like
the
end of day
same. I
squeeze,
will say that the inflation data
listen
that
to
we
what
got,
Powell's
your
saying,
point,
see if anything
really
might
pointed
spook
to
the market,
stronger
or watch
inflation.
any of the other indicators to
I
see
could
if it
follow up on
changes.
that. I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree. And
Been a pretty good scalp so far. It looks like we're moving in like
and are you
2-point
not seeing more
increments
coming
before
from
we
that
see
because
chop. You know,
you don't know, or
2
because
points,
you just
chop,
wanna have,
another 2-point
another
breakout.
round of wishful thinking?
We just
it's
had
really
another.
just a
I'm on-
question
We just
of
had another
not
2-point
knowing
breakout.
At this point, there's
I'm on the 2-minute
great
chart,
deal of literature
so
on the connection
that's a good
between tighter
observation
credit
there.
conditions, economic activity.
Yeah, it looks like we
hiring,
break
and
out for like
inflation.
a point or two at
Very
a time,
large
and then we
body of
kind of see
literature. The question is,
capitulation.
how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. You know, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for, you know, being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened,
There you go.
and then
Some
I'll come
positive
to
Shay's going to say.
the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank
That's
to
it.
significant liquidity risk and interest rate risk.
Blame management.
Didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and
Nice little
transparent.
kind of flag here.
It
Just
is
kinda
clear
hanging
to
out.
to your last question.
Yeah,
It's
we're
clear that
hanging out
We
this-
do need to
But I'm worried that
strengthen
people may get
supervision and
spooked and
regulation.
sell, so I don't want to hang out here too long.
I assume that there will be
Well, we're starting
recommendations
to
coming
get
out
to
of the
the top
report,
end
and
of this
I plan
flag
on
here,
supporting them
hopefully.
and supporting their implementation.
Sorry, and the final point, can we feel confident that
VIX
these weaknesses
continues
don't
to
exist
fall off,
elsewhere, given
which
that
is
they
below
got missed
20.
at this bank?
These are not weaknesses that are at all
Regionals are kinda
broadly
popping
through the
up
banking
now?
system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or
Yes.
is there something different about the way
Pricing in rate cuts that
you're
quickly,
looking
I
at
think,
it,
is
given that
stupid.
you're now thinking that
Last time it took the
moves
Fed,
might
I
be
think,
appropriate
7
as
months
opposed to
maybe before
ongoing?
when they stopped
So we published an SEP today,
cutting
as
or
you will
raising
have
rates
seen,
to
and
when
it
they
shows
finally
that,
flipped to
basically
cutting, but
participants expect relatively
maybe
slow
sooner, but
growth, a gradual rebalancing of supply and demand in the labor market.
well,
with
actually,
inflation
7
moving
months would
down
be by the end of the
gradually.
year. So
In that most likely case, if that happens,
Like to see us cutting by the end of the
participants
year.
don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the
Right, I see
idea of you
people head
don't
for the
know
hills
what's
here
going
on
to happen?
market.
In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to
Liquidity zone
depend.
here.
Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Like a stab off the 40-50 level. Just see if I get 5 points.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a
Not
bit about how
holding
Silicon
them.
Valley Bank was unique to a certain sector of the economy,
No.
but there's also growing
It's on
concern
hold
that
here.
there are financial stability risks from the commercial real estate market and loans that will begin to roll over
Yeah, I'm
later
out.
this year and
I'm playing
next,
around with that.
and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be
Yeah.
independent investigations.
I was going to say, they're not going to be like,
Outside
it's fine, the
investigations
Fed
and all
looked
that.
at it.
So, we welcome.
Right.
When a bank fails,
What a
there
stupid
are
question.
investigations,
Yeah.
and of course.
No, Powell doesn't want anyone poking around in some shithole at Silvergate Bank.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things.
I
and,
thought he was going to say stick it
we
somewhere
have
else.
responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at
Try to get them to say,
the
fuck the
impulse
government.
from spending, because spending was,
Right.
of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
I think the
Chair
market's
Powell,
digested
Yellen
the
with
extent of the
Axios.
dovishness,
Two
and
questions
I wonder
about
if this is
aspects
going to
of
be the end of
government's
the play. I
response
don't
to
know.
Silicon Valley Bank 2 weekends ago.
Yeah, it's,
First,
What
why
more
is this
can he
new debt
say?
funding facility, done
We need
under
to
reference
watch
13.3 authority as
the
opposed
low
to
of this,
expansion of the discount
you know,
window,
down
changing the
below
term of the discount window that's
40.25
been
to
around
see
a long
what
time.
happens there.
And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143
We
billion
got the
on
VIX
your balance
popping, we
sheets
got
last
dollar
week,
popping,
supporting
got
that
rates
deposit guarantee?
popping.
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see
Nice
what that
pop
is.
up in the
And
VIX.
we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with
Just
the
so
objective
people
of
know, I've got a call,
reducing
so
the
I'm gonna
balance sheet. And I'm also
shut my
curious what
mic
your
off
thoughts
here on
are
my thing, but I'm still going to be on the headset. So
not
if
just
you
the
need me to
availability
kick
of
you over
reserves,
to the
but the
charts,
distribution
just
of them
let me know and I'll
throughout
do
the
it.
banking system.
I got to
All
pick
right,
up
thanks,
this
Nick.
phone.
And at what point you might be concerned about it being scarce for certain banks.
So, so people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless, what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that
You're
de
getting
facto
a drop down,
deposit
not off
insurance
Powell,
covers
but
all
Yellen just
savings?
came out and said we are
Shouldn't
not
Congress have a say
considering
in
insuring
that?
all
And just by way of
uninsured
example, if a bank with
deposits.
less than $1 billion in assets failed, are you promising to
If you're
bail out
wondering
all
why
of
we're
its
dropping like a
depositors?
rock right now.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that
This is on the
we
Yellen
have the tools to
commentary.
protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was
This is
agreed
why the
to,
tape
and it has
syncing is
been,
on Yellen.
the markets have
This
accepted
has
it.
nothing to
and,
do with Powell.
It seems to have gone well, and I think there was a concern that it might not go well. So coming
Yellen said
into
they
the
are not
middle of this
considering
week, yes,
insuring
I would
all
say
bank
that has gone
deposits
well
like she had said
so far.
before. So this has nothing, this fall drop has nothing to do with Powell right
Hi,
now.
thank you, Chair
This
Powell.
is
Nicole
all
Durkheim
Yellen
with CNN
walking those
Business.
comments back.
In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't
hasn't read
get
anything.
inflation back in place, get inflation, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to...
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do
I've
you
been on a
factor
short
that
since
into your
29. I'm thinking about covering in here somewhere.
It depends
40,
on
10.
whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very.
All right, I'm
good
out
for
of this
people.
short.
You see late in an expansion,
Nice 20
you see
points on the
low
ES.
unemployment, you see the benefits of wages going
I
to
think
people.
we could go lower.
at the
It's
lower
a
end of the
big
wage
deal what
spectrum.
Yellen
It's
is
just
saying,
a place that
and
we
if
should
they
try to get
can't-
back to.
If they can't walk that back, then
Hi, Chair Powell. Jean Young
this
with
market's,
Market News.
it's
I just wanted
it's
to ask, with all
losing the
events
main
of
reason that
past
it went
2
up.
weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these
Lie.
events have had much of an effect.
Lie.
It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, in particular immediate attention. And I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. You know, what can we do to make sure? But again, that's not for me to answer today.
So you don't have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, you know, this review is going on, and you know, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. You know, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, you know, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were
okay.
to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, you know, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, you know, what will be the extent of it, and what will be the duration of it, and then, you know, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, you know, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, you know, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and you know, so that's all I have to say. So,
thank you.
Thank you very much.
All right, guys. Interesting curveball thrown at us. So I'm going to pull up the charts, and, you know, Yellen pulling the rug out from everybody in the middle of Jerome Powell's presser. I definitely didn't have that on my bingo card, but you can kind of see here getting a nice little pop off of this bottom. But, you know, make no doubt about it, this whole thing was all about, hold on one sec, I'm just trying to pull my stuff up here. So I can follow you guys in the chat. Really? Sec. This is stupid. This freaking thing. Okay. So yeah, I mean, you know, Yellen basically, look, the market had a strong rally off the bottom yesterday and a strong rally in here because of the fact that Yellen was backstopping everything. said that, basically we're gonna handle rates, and we're gonna handle all depositors. And now during the meeting, she basically has come out and said that they're not looking to do that. They're not looking. So it's just, I had a nice short on that news event, but it's just crazy. It's just crazy looking at that. KRE dumped. Overall, not a great trading day for me. I am that last short got me positive, but I mean, I didn't catch all of the moves. So I just, again, tried to be a little bit more cautious. But that Yellen news is significant. And, it basically has taken away the reason that the market was running up. So it's definitely something, now we're kind of getting the counter rally out of here. And the reason we're kind of rallying now is the pressure's over, and you typically get some kind of counter rally in here. And it'll be interesting to see if you are trying to trade it up. I mean, I'd look at this low to see if this low can hold in here. Let's see what we get. I'm just looking to see if I want to, put on any positions in here. We're kind of at an important level from a market perspective. I see that tech is kind of popping back up, look a little bit more greener than maybe some of the other indices in here. So, let's see if we can get a nice little rally out of here. So I did take a trade right there. So I just took a short little scalp from here to here. Just very, I still in more positions. I'm just, again, I took the risk off. But if you look in here, this was my stop. So now we're kind of up into this area. Expect a little bit of a maybe pullback in here. Watching, the VIX kind of surged up to 22, kind of pulling back now in the 20.5. I still, I'm not comfortable staying obnoxiously long in here. And the reason I'm not that comfortable is because of where we are. Just that whole Yellen thing is kind of like was a rug pull for a lot of people. But I thought overly it was a dovish kind of presser. I feel like, had Yellen not come out, I probably would have been going a little bit more aggressive in here on any pullbacks. But, we probably wouldn't have got this pullback had Yellen not made those comments. So it's kind of giving you an opportunity to question is, what do traders do? So going forward, you're going to have to let the market decide. We're in an interesting times. Again, no matter what you think of the banking crisis, yeah, and that's right, Mal, they're kind of burning at both sides. But it's interesting that she did come out and while he was talking, and there's some material news that came out. But no matter what you think of the banking crisis, it can get worse. Okay, it can get worse. Right now, credit spreads are not getting worse. You're not seeing it in the junk yields. You're not seeing it in a lot of different things. But who knows how bad it is. And, that's the thing. If some of these banks got to start liquidating positions, then obviously that becomes an issue. But it's tough, man. It's tough. You had a nice little good call out, Tyler, on gold. He had a nice little pull back into the 50% and then kind of push out of there. Be careful in here. I'd want to see gold get back above 1970, or also kind of looks like a head and shoulders top to me. You don't want to see gold lose 1958 if you're just looking on a short-term basis. So it's kind of in here. It's okay. I like to see it back above 1970. I don't want to see it to fall back below 1958. And, I think with what Yellen said, that's bullish for gold going forward. So, I think it's definitely bullish on gold. But you want to be careful. You want the market to kind of make its decision, and you're going to have to see how the institutions are. And, you can see this is the scene of the crime, guys. So, if you're looking at the action, this is the scene of the crime where we went from the FOMC meeting Right now, we did pierce through in here. We did fall back, make a new low, and we're kind of fighting in this area as expected. A lot of liquidity up at 40.50. If we could get back above and maybe retest, that would be bullish for me. But I don't know. I'm not as bullish as I was. I thought we were just going to keep on going here, maybe up to 4,200. So we'll have to see. It looks like the dip buyers are kind of to show up. And I'm just looking in here at some of what we're looking at. Equities appeared. Yeah, well, we know that, Nick. Just going through my feed here and seeing if we see anything that we haven't caught ourselves. Yeah, and there's a nice little bounce out of here. So nice little push. Seeing rates kind of fall off in here. You had KRE make new lows. Now we're kind of getting going up towards that 40-50 area. So I want to see how it reacts in here. And again, don't forget, we've had many misdirections even into the Fed close. We could finish strong today, and then after traders reassess the Yellen comments, we could see the markets just completely fall off. But I think right now that's about it. I'm just watching this 40-50 area, just watching how this zone, kind of how we trade in here. Because this is, we got a lot of fight left up in us in here. Just looking, seeing some bouncing in some stocks and stuff. So just watching. So rates are coming down on the 2-year, which is a good thing. We are at highs here. Okay, so we're now kind of, we're trying to fight through here. VIX is at 20 again. VIX keeps on falling off. That's a buy for me. So VIX is at 20, man. Nothing to determine, to push VIX out of here, huh? So I just added a little bit in here, just small. Maybe we'll see if we get a little run. I would add positions all through here. Let's see if Nick's here. Nick, you there?
I'm here.
You're muted, by the way.
Sorry, I was muted to you, not the stream. So yeah, I didn't realize I didn't unmute in Zoom. Sorry. No, but
yeah, no worries.
So
what's your final thoughts here? I mean, I had never seen that where we had Yellen come out in the middle of the presser and kind of pull the rug out from Powell.
Yeah, maybe she misses the days where she was in that seat. I'm not sure. I wanted to steal his thunder, but I mean, it's going to be interesting. Well, I think a big tell is going to be how the week how the day closes and also how the week closes in terms of volume. It's going to be something to watch because the volume's really dropped off since that bottom. Powell obviously came in super dovish, and that kind of put a little bit of a wrench in. I don't think it put, thinking about it as a whole though, I don't think it puts that much of a wrench in it because Powell kind of tried his best to dissuade any fears that there's even going to be a need for them to bail anything out. So what Yellen says kind of is hopefully a moot point, hopefully. If we see signs that Powell was wrong, then it becomes a bigger problem and those words will probably loom large. But based on what Powell said and based on the market's reaction to what he said and how we scooped off the bottom with some extreme volume over the last week or so, I think the market's probably not going to worry too much about what Yellen said, unless we do see ripples start to happen again. I'm still worried about the selling pressure coming in because of that sheer amount of buying that we did have in like the March 13th to March 16th range. So I wouldn't be in any long-term long positions. I could absolutely see a squeeze because of how pessimistic people were coming into this. And you could even see it in a lot of the questions being directed to them, though I guess they always are. So I could see maybe a short squeeze, but I would be selling into any longer term squeeze here. Other than that, he kind of kept to, Powell has never shaken up the markets. They always show their move 10 months early almost. So if anything does change in their long-term forecast, I think they'll give us plenty of time to see it. So.
Yeah, Mark, what's interesting is when he was asked that question, he took like a little 10-second pause, and almost smirked. That's a stupid question to ask me. Like he knows there's no
Yeah.
soft landing in the works.
Yeah.
But he is right. I mean, but I tell you what, oh, shoot. I had an order hanging out there. Anyhow, the thing that kind of makes me look and say, the reason we were kind of going up was on the Yellen thing. Yesterday, when she kind of came out with those remarks, market kind of
Mm-hmm.
bought off the dip, and we had a nice little run. And I thought that might get a little wind under our sails, but if the Treasury's not going to be
Yeah.
playing ball in that regards, then I think it's definitely something long term to look at.
Yeah.
Definitely something long term. Watch the banks, guys. The banks are going to be your clue.
Yeah. And let's not forget what with all the things that have happened today, looking at the market price action over the last almost year now, or not even a year, a couple months, whatever, it's choppy and ugly. I don't think that's going to necessarily change anytime soon. But so it'd be short to medium term trade length for me anyway. So
yeah, absolutely.
Yeah.
All right, well, we're getting rejected right off that 40-50 area pretty much. Let's see what happens. We're back down, past the scene of the crime. So see what happens here. Thanks for tuning in, guys. It was fun. It was good to be back. We're going to be, doing some things with this stuff going forward, and so keep an eye out. And,
Yeah, no, absolutely. We're gonna it's gonna be fun, but we'll obviously all be around in the Discord. I'll probably be a little more active, and you'll see me slowly start to step back in the limelight here. But it was a lot of fun sitting around with you all, and we'll see what we get.
Yeah, we'll see you in Discord. Thanks, guys.
Thanks, everyone. Safe trading.